time, you can go through this 2021 paper. Yes. Right. Today we are going to discuss. Last week we discussed macroeconomics. This introduction is important. First, we discuss the key macroeconomic account. This was one of the questions in the paper 2021 paper. Explain at least 4 indicators which were widely used in macroeconomic analysis. 4 economic indicators which are widely used in macroeconomic analysis. This is the answer: national accounts, public finance or the government budget, balance of payment, monetary survey. The monetary survey, sometimes they have written inflation, unemployment, the government budget, national accounts, growth rate. Various names are given. So even if you write this, the national accounts, public finance, BOP, these are the accounts. Within that account, you have the indicators. National account, GDP is the indicator in relation to national account. GDP is the indicator. Public finance, government budget. Balance of payment account, the current account balance, trade balance, this. Monetary survey, money supply, and the inflation, these are the indicators, right? National account, GDP, unemployment, employment, these are the indicators. This is the broad accounts. In that, within that account, you have the indicators. Like the human wealth, human health. When you check, you have various reports. Within that report, you have different the measures: HDL, LDL, total cholesterol, triglyceride, like that. The cholesterol report, like that. Okay. This is please go through this 2021 paper. You can find. I'm marking this paper. I'm not quite happy, but you can't say it is not that bad. Average. Pass rate is average, right? Okay. Now today we are going to discuss this one: principles of economics, introduction to textbook models. Textbook models. Because they are, when you study economics, there are 2 main branches: micro, macro. That is one branch. Positive, normative, another branch, another classification. Now here the subject economics, you have basically you study under 2 the aspects. First, the theoretical economics, theoretical models. Other one is applied economics. How you apply this? Applied economics. So the theory and applications, there are some clashes. In the theory, we discuss certain things, but if you go to the real world situation, when you go to apply these theories, you may not see the theory as it works. Broadly, it works, but sometimes you think of this theory we learn. This is the one. You want exchange rate determination, demand supply models, market structures. When you go to the real economy, real world, you may not see the actual behavior, but underlying theory is there, right? So therefore, we discuss textbook models and the applied economy. The applied economic best text is the Central Bank Annual Report. Central Bank Annual Report discuss everything about the applied economics, what is happening in the economy, direction, which direction our economy is moving, what are the lags and leading indicators. All these are applied, real world situation is there, not the theory. But based on theory, theory works. Indicators, underlying theory is there. That's true. We can't say theory doesn't work. Theory works. Another reason why you can't see these applied models, theory, textbook models, and the applications and the theory different, because in the real world situation, everything changes. For example, theory of demand. We discussed there is a negative relationship between the price of a good and the quantity demanded when other factors are held constant. That is the theory. But if you go to the real world situation, you may not see that. Why is that? Other factors are constant. Ceteris paribus assumption is not satisfied. Therefore, sometimes you can see some different directions. Demand, quantity demand, and the price moving different directions, right? So that is the main reason. Lots of other interactions, factors are there. They are also moving. You can't fix something. Okay. Now in this chapter, we are going to discuss textbook models. The role of a model. Models mean to explain the behavior, to describe the economic behavior. We discuss different models. I go to the expenditure system, national income, C plus, I plus, G plus. I will explain that. You are familiar with this model, C plus, I plus, G plus, X minus M. Then the ISLM model. Then we'll discuss of course, one of the model, aggregate demand and aggregate supply model. Aggregate demand and aggregate supply model, right? Okay. Model is to enable the economists to isolate the principal relationship between economic variables and to explore the logical consequences of changing this relationship. Model. Definition of a model is very complicated, maybe. It's not simple. I will explain from layman's language. We can discuss the model, economic model. What is an economic model? I think we have discussed this earlier. Economic model about is like a roadmap. Roadmap. For example, if you want to go travel from Colombo to Anuradhapura, you take the road map or the GPS. Road is indicated. When you start the directions, it gives all the direction from here. If you take this Kandy Road, the Varakapala, then the Alawa, Purnagala, Dambulla, like that, you can take different routes, shorter routes or the shortest time. You can take the GPS might indicate all this time. Or if you expand this, you can see the main roads, main points, right? Hospitals maybe, right? Police stations you can see, other railway stations, right? You can see. But in this map, in the road map, you don't see any small things, small boutiques you can't see, small schools you can't see, right? So what is the roadmap? Roadmap is a good approximation to the reality, actual situation. It's a good approximation. If you have the roadmap, you can, the foreigner, they have only the roadmap. Take the small book or the GPS sometime, Colombo, take the bus from here to Anuradhapura, then he travel everywhere using the roadmap. It's an approximation, approximation to the reality, actual situation. Economic model is like that. It's an approximation of the reality. How the economy works. How does the economy works? So using a model, we try to explain. Demand supply model. Aggregate demand, aggregate supply model. So it's a very good approximation. It's a textbook model. Then we after actually this session we are going to discuss ISLM model, another econometric model, economic model. They all try to explain, describe the working of the economy, real economy. They are called textbook models. National income model. Y equals C plus, I plus, G plus, X minus M. So these are the models. Now like that, economists use basically 3 basic models to understand the economy, structure the economy. Remember, model is not 100% accurate. It's a proxy, approximation, good explanation. The explanation about the economy, right? In macroeconomics. For example, microeconomy, when you say model, now you know indifference curve approach, theory of demand. They are models. theory of markets, perfectly competitive market. Then monopolized market. Then you have the monopolistic competition, oligopoly model. Right? So these are textbook models. So when you go to the real world situation, these markets you can see sometimes they might not work as it is, as explained in the theory, but they are model. Microeconomics is the large number of models. Macroeconomics is the large number of models, textbook models. Applied economics, different. Right? Application. Central bank annual report is a good example for the applied, to understand the applied economics. Real world situation. Right. What are the three types of models? Model 1, the expenditure system. This consists of national income identity and a number of equations determining various components of national income expenditure. Remember, last week we discussed three models about the national income expenditure system. Basic model, closed economy without government, closed economy with government. Then we discuss open economy. Now this is about the open economy. Open economy model, the national income, economy generates GNP. This income goes to the households. What do households do? They consume, pay taxes. Then they demand the imported goods. Balance is same, right? Y equals the C plus, P plus, S plus M from the household size. Then the firms, what do? They produce consumption goods, investment goods, C plus I, goods and services for the government. Then again, they produce exports, C plus, I plus, G plus, X. Then total income, but when you say national income, we can say our total output C plus, I plus, G plus X minus M. M is coming from outside, no? So that is the model, expenditure system, C plus, I plus, G plus, X minus M. Right? Then the second model, ISLM model. ISLM model is a technical name for this one. ISLM model. This model develops schedules for equilibrium in the goods market and the money market. For a market for rice, remember in the free enterprise economy system, demand for rice, supply of rice. Demand for paddy, supply of paddy. Market for fish, demand for paddy, demand for fish, supply of fish. In the macroeconomy also, we have real sector and the monetary sector, goods market and the money market, financial sector and the real sector. Like demand supply, IS curve summarizes the equilibrium in the goods market, real sector. It's a downward sloping curve. LM curve is upward sloping line of the curve. It summarizes the equilibrium in the money market. So ISLM, like demand supply, the IS downward sloping, LM upward sloping. IS schedule is derived from the above model 1. Actually, to derive IS curve, we need the model 1, but differs in that investment spending. Yes, right. We'll discuss ISLM. We have a separate lecture. The Y equals C plus I in the national income model. The IS curve is derived using for the simple model, closed economy without government. We know Y equals C plus I. The investment, actually, to derive the IS curve, simple IS curve, these two equations are used. Simple model, Y equals C plus I. Investment, we assume, is a function of interest rate. Why? When interest rate increases, cost of funds increases. Interest rate increases, cost of funds increases. So then investment goes down. Investor might think, okay, the high interest rates, I should not, this is not the time to invest. I will postpone my investment. Right? So I will stop this investment, this interest rate. Now this, now at present, what is happening to Sri Lankan economy? before the COVID, pre-COVID period, we had a very high interest rate. We had a high interest rate regime. Because of this COVID, the government purposely, central bank purposely cut the change their policy rates. SDFR, the lending rate, deposit rate, or the repo rate, reverse repo rate, standard deposit rate, standard lending rate, in other words, reserve ratios, then the bank rate, upward revision, downward revision. Then when they change these interest rates, market interest rate also went down. Nowadays, now actually the deposit rate has come down to 10% per annum to 4%, 5% per annum. We are moving towards low interest rate regime. Low interest rate regime. In a way, it's good. That will encourage investors. Investors are happy, but savers are not happy. Fixed income earners, the retirement people, retired persons are not happy. Because they are living on their savings, monthly savings. They are not happy. Then government is in a dilemma. Because the economy is coming down, economy is collapsing. So they want to encourage investors on the one hand, so give relief to the SME sections, small and medium exchange, medium the investors, SME sector, to encourage them, give low interest rate regime is important. Then what will happen? Consumers, savers, pensioners are affected. So that is the trade-off, dilemma for the government. So in most of the countries, the post-COVID period, interest rates coming down, low interest rate regime, because they want to encourage economic activities, investors, right? That is the. Then what will happen when domestic interest rates are coming down, financial market, then the government, the banks interest rates are coming down, what will happen? Then people look for share market. They don't want to invest their funds, money in the deposit their funds in the banking system. They withdraw and go to the share market. If you are risk lover, share market is a risky business. Risk lover, you have to take some risk. Then it might go up or down, but they think, okay, the share market is now these days, that's also happening. Share market is booming. Banking rate, bank interest rates are falling. Then people shift the money from, bring their money from banking system to the share market. Share market is booming. That is one of the reasons. Maybe there are so many other reasons to boom in the share market, right? But share market is good. This kind of the inverse relationship always you can observe when the bank interest rates are falling. That will give you a push to the stock market, share market, right? Okay. Now that we'll discuss ISLM model. We have a separate discussion. I will have one or two lessons, right? Okay. Now this is the model LM. IS curve. To derive the IS curve, we use C plus I and the investment, the relationship between investment function. Money market behavior is used to derive the LM curve. The LM schedule is derived using the money market equilibrium. Demand for money equals supply of money. Demand for money equals supply of money. Who demand money? People demand money. Economic players demand money. So the demand for money depends on interest rates. Demand for money depends on income. There is a negative relationship between demand for money and the interest rates. Money. Simple terms, layman's language, notes and coins. Let's say I have 100 rupee notes. So when interest rate going up, bank interest rate going up, I don't want to keep my 100 rupee with me. I will go and deposit this. When interest rate going up, I don't want to keep money. I don't demand money. I will let money to be in the banking system. Demand for money. That's a negative relationship between interest rate and demand for money. Right? Negative relationship, investment and interest rate. We should be able to explain that. Not only that, there's a positive relationship between income and the demand for money. When income increases, GDP increases, economic activities increases, demand for money increases. Demand for money increases. So demand for money function is that. So to derive the LM curve, we use this demand function. Money supply is independent. It's a central bank baby of the monetary authority. Sole authority lies with the monetary authority of the country. Monetary authority of a country, Sri Lanka's monetary authority is central bank of Sri Lanka. Singapore, it is a monetary MAS, monetary authority of Singapore. The Bank Negara is the Malaysia's monetary authority, central bank, right? Bank of Thailand, Reserve Bank of India, Fed. These are the monetary authorities. So changing money supply is the job of monetary authority. How do they change? By changing this reserve ratio. They have interest rates coming under certain interest rates coming under their purview. They change those things. By changing those things, they can affect the final money supply. Right? So money supply independently determined by the central bank monetary authority of the country. So the money market is in equilibrium. Money supply equals demand for money. Central behavior of the central bank, demand supply, and the behavior of the people, other players in the economy consistent. Demand for money. Using that relationship, we derive the LM curve. Then the aggregate demand, the ISLM model. Remember, these are introduction. Very brief introduction. We have a separate lesson to this ISLM model. In the paper, generally you get the separate question, one full question from the ISLM model. Now, if you look at this 2020-21 paper, question number 8 is full about completely based on this ISLM model, right? Next model, third model, aggregate demand and aggregate supply model. Macro models, all three are macroeconomics model. Microeconomics are models, perfect competition, one model. Monopoly, another model. Oligopoly, another model. Then the demand supply, another model. The consumer behavior indifference curve, another model, like that. These are macro. Aggregate demand and aggregate supply. Aggregate demand of the whole economy. When you say aggregate demand, y-axis, total output, GDP. X-axis, y-axis, price level. Please remember the microeconomics. When you draw the demand curve for demand for rice, quantity of rice, x-axis, price of rice. Quantity of the bread, price of bread. Now, in aggregate demand axis, total output in the economy, total output, total GDP, and the price level, not price of one particular good, price level in the economy, price level axis. So aggregate demand curve is like demand curve in the microeconomy. Aggregate demand curve is downward sloping curve. Higher the price level, lower is the demand curve, Y, output Y. There are various the explanation. We'll discuss why there's a negative relationship between price level and the output in the economy. Aggregate demand curve or downward sloping aggregate demand curve. Wealth effect, we'll discuss that. What will happen when price level increases? Why people why the economy's output decreases? Aggregate supply. When price level increases, output increases. Like microeconomics, one particular good. If you take when price increases, price of fish increases, supply of fish increases. Positive relation. Aggregate supply curve. These are AD and As for the whole economy, whole country, whole economy. The third model adds a supply side to the economy, model 1 and model 2, right? Okay. Now these are the three basic textbook models. National income model, expenditure system, ISLM model, goods market and the money market equilibrium we discussed separately using that model. Third model is the aggregate demand and aggregate supply model, ADAS model, right? So the textbooks, if you take any textbook, Now, all these three models are there. National income in macroeconomics, national income, ISLM, ADS. Some economic concepts, given economic shock, economic policy, when they explain, they use sometimes ADS and ISLM. Sometimes they use all three, ADS, ISLM, and the national income identity. All three models are used to explain the behavior, shocks coming to the economy, right? But today, we are going to discuss the first model, the expenditure system. After that, we'll have the ISLM model, discussion on ISLM model, macroeconomics. Then we discuss the ADS model. Sometimes at the end, we try to combine these two and explain certain economic issues, economic problems, economic shocks, right? Expenditure system. Model 1 is explained using the three structures of an economy. Model 1 is what? National income model, expenditure system. Closed economy without government. Closed economy with government with lump sum taxes. Lump sum tax. Closed economy with government without law. There's a small mistake here. Part C, closed economy with government with lump sum tax. Third, part C, closed economy with government with proportional taxes. Please change that. For the B and C same, no? C should be closed economy with government with proportional taxes. Proportional taxes. What is a lump sum tax? Lump sum tax, just to explain, irrespective of the income. Irrespective of the income. If the people, players, people, income earners pay same amount of the tax, whether you are getting 1 million rupees or 1,000 rupees per month, per year, your tax rate, taxable income is 1,000 rupees, taxable income is 1 million. If you pay 5,000 rupees, irrespective of the level of your taxable income, you pay same amount, then it is called lump sum tax. It's not a good system, right? Whether you are poor or rich, rich people or the poor people pay the same tax level, tax amount, same, not fair, not fair, right? So then the proportional taxes, I want to change that. Proportional taxes mean this your tax rate increases with income. Marginal tax rate 2% for the low income people, 3% for the middle income people, 5% for the rich people. So the rich people proportionately pay more tax. That is fairly reasonable if you take about income distribution aspect. That's good. Rich people proportionately pay more progressive taxes, right? Proportional taxes. Then the open economy model. First three models, we don't have import exports. Open economy model, import and exports are also introduced. Closed economy model, national income equation is y equals c plus I. Right? Like that, you first define first equation. After that, you derive the national income. Mathematically, we try to calculate GDP or GNP. Using equations, we try to calculate. That's why I call the mathematical approach to this calculating national income. I think I'm sure when you are doing your A-levels or the chartered or the some degree, this kind of mathematical approach is used to calculate GDP, GNP, disposable income, tax rates, government taxes. You use mathematical equations and calculate. Now that part is discussed here in this lesson. You are familiar with this basic model? No government, households, firms, two players. Households have all the factors of production. They supply the services or factors of production to the firms. What are the factors of production? Household has got labor, land, capital, they provide capital. Also household has the entrepreneurship, that's a resource, factor of production, that also they give to the firm. Firm is just an entity. But the firms get all these factors of production, services of factors of production from the household and produce C and I, consumption goods and investment goods in the economy. When they produce these things, the returns going to the income, households. The households are the king, owner of the factors of production. Final output, value of the output should come to the households because they are the owners. Payment should come to the households. For labor, they get wages. For capital, they get interest. For land, they get rent. For the entrepreneurship, they get profits. Like that, total Y. Then what do? Households independent. They finance their consumption. C. Then again, the savings. Balance is saved. Y equals C plus C. Now we'll discuss the model. GDP equals C plus I. GDP equals C plus I. This model is equal to the GDP equals the C plus I. Total output in the economy, GDP, C plus I, that equals to Y also. Balance, equilibrium, at equilibrium, demand, supply equals the demand equals supply. Right? GDP equals C plus I. Now the question is, now we have to discuss what is C? Consumption expenditure. Consumption depends on what? Tell me. Household consumption, your consumption of household depends on what? Tell me. What is consumption? Consumption depends on what? Yes? Tell me. This is the question. What are the factors that determine the person's consumption? Yes? Tell me. Consumption depends on what? Yes? You consume, you can consume, you could consume if you have income. Consumption depends on income. Why? Right? Income by. So consumption is a function of national income. So think about this is a macro concept. Total consumption depends on total GDP, income. C is a function of income. Right? So we use this equation for the consumption function. Consumption 50 plus 0.8y. Now both 50 and 0.8 has some specific meaning. Consumption function, general formula, C equals C1 plus CY. If you use some numbers, any numbers. Now in the examination, they usually give the numbers, right? The equation with the numbers. Right? So, but these numbers have economic meaning, very important economic meaning. Sorry. 50. 0.8. 0.8 is called MPC, marginal propensity to consume. MPC, marginal propensity to consume. 50 is called autonomous consumption. 50 is called autonomous consumption. Take down that. Autonomous consumption. 0.8 is called marginal propensity to consume, MPC. Right? Investment, we assume it is 50. At the moment, we assume investment is given. The ISLM model, we have different investment function. Investment is 50. Fixed investment. Consumption function 50 plus 0.8. If it is called autonomous consumption, what is autonomous? For example, if y is 0 in this equation, y 0, then 0.8y is 0. As a result, C equal 50. Now we can define this autonomous consumption. What is autonomous consumption? When income 0, consumption level when income is 0, y equals 0. That is called autonomous consumption. That part of consumption which is not which is not a function of income, independent of income. The part of consumption independent of income, y 0 consumption. Because we need this income, whether we get 0, whether you got 100 rupees, 1000 rupees, 1 million rupees, even your income 0. Your minimum income, minimum consumption is 50, autonomous consumption. Irrespective of income, your minimum consumption 50, autonomous consumption. 0.8 is called marginal propensity to consume. What does that mean? When your income increases by 1 rupee, what do? Households consume, save in this model. When income increases by 1 rupee, consumption will go up by 80 cents, 0.8, 80 cents. Income increased by 1 rupee. Consumption will increase by 80 cents. Then balance 20 cents, saved. MPC is called the change in consumption divided by change in income. I will go to this board now. Right. Now you can see, can you see the board? C equals MPC, marginal propensity to consume. That is called MPC. MPC equals 0.8. 0.8 is MPC. Number 2, autonomous consumption. Equal 50. This is autonomous 100. Yeah, I'll 15 or 50. Sorry, 50. 50. Autonomous consumption 50. MPC. What is MPC? MPC is defined as change in consumption divided by change in income equals 0.8. What does that mean? If your income changes by 1 rupee, consumption will change by 80 cents. Change in consumption divided by change in income is the MPC. Autonomous consumption is when income is 0. Consumption when income is 0 is called the 50. Value of consumption when income 0. When income is 0, this is 0. 50. Consumption 0. Consumption when income 0 is 50. That is called autonomous consumption. Even household, you don't get any income for a particular month. You have to consume. That level of consumption is called autonomous consumption. Even the country, income is 0, GDP is 0, but consumption of the players, total consumption should be there. That level of consumption is called autonomous consumption. Right. Now we know that equations y equals C plus I. C equals 50 plus 0.8y. I investment in this model, we assume expenditure model, national income model, we assume investment is not a function of the interest rate. It is 50. But in the ISLM model, when you say the goods market, definitely you have to change the investment, the function. You have to use the investment function. It is 50. I think 50, no, it is 50 years. Now, to calculate income, what do you do? Remember in this model, what is the equation is 50 or 100, autonomous consumption 50 or 100, I can't remember, yes. Wait a minute, I'll come now. Yeah, 50 and 50, yes, right, okay. Right. Right. Now you can see how do you calculate national income? You calculate this Y. We substitute C equals 50 plus 0.85 plus 50. I is 50. Then Y equals 50, 100 plus 0.85. Take 0.85 to this side. Y minus 0.85 equals 100. Y minus 0.8y is 0.2y. Therefore, y equals 100 divided by 0.2. What is the number? The 100 divided by 0.2. The 500. No. 0.2. Yes. 0.2. 0.2 is 1.500. 500. Understand? Remember this model? GDP Y equal 500. GDP equal 500. GDP. Firm, business, households, and the firm. Consumption, save. Investment. Investment 50. Investment 50. Right? Investment 50. 500. Then consumption should be 450. 500 equal 450 plus 50 is 500. Balance. That side. Consumption 450. Savings 50. This 500 come to the end. Yeah, so out of this 500, people spend 450 for the consumption goods. Balance is saved 50. Investment equals savings 50-50. That's how this model works. Understand? 450. This 450 can be, we can derive 450 using this equation. C equals 50 plus 0.8 Y. Y is 500. Y is 500. 500. C equal 50 plus 0.8 into 500 is 400. That is 450. Understand the calculation of 450? I just calculated this is 500. We know investment 50, no? Investment 50. Therefore, consumption should be 450. So this 500 should be equal to 450 plus 50. But this 450 you can obtain if you substitute this Y into the consumption function. 50 plus 0.8 into 500 is 450. From the household size, what will happen? Consumption, value of consumption goods is 450. They spend 450 rupees to consume. Balance, save. So investment equals savings in this model. What does that mean? Firm's investment is financed using household savings. Another interpretation. Household savings 50 is investment 50. They balance. Correct? Now, if you can understand this model fully, Simple model, closed economy without government. Go to the right. Simple model. C equals C1 plus CY, then 50 plus 0.8 Y, investment 50. You substitute this equation to the initial identity, then you can get Y equal 500. 500. Yeah. Now we calculated when income is 500 in this model, the board we calculated, no? Consumption 450, consumption 450 in this model. Total output is 500, GDP 500, investment 50, consumption 450. We can calculate this 450 using the consumption function. We substitute 50 plus 0.8 Y, you can get the consumption. That is, this side it is balanced. Total value of the output is 500. How to distribute? Consumption goods value 450, investment goods 50. This income generate to the income, another interpretation of the household side, generate income 500 to the households. They demand 450 value worth of goods and services from the firms, 450. Balance is saved, balance 50. Very simple model. Right. Next, I want you to calculate. Please calculate this. If investment increases to 60, other factors same. Consumption function same. Investment increases to 60. From 50 to 60. What is the new equilibrium income? It is there, but I will give you 5 minutes to calculate this new income. Y equal 550. Please calculate that income. Please calculate same equation. Same equation. Calculate. Get the answer. C plus I, 50 plus 0.8 Y. Substitute and get the answer. 50 plus 0.8 Y. Same concept. Investment 60. Then go through this formula and how to get the 550. 550. Value 500. When investment 50, national income GDP was equal to the 500. Now investment in the economy increases. Investment increases, same consumption function, investment 60. You simplify this and then 10 plus 0.8 Y, the 0.2 Y, Y minus 0.8 Y is 0.2, Y equals 100, Y equal 550. Now this is interesting. Investment increases from 50 to 60 by 10 million, let's say 10 million. Investment expenditure, firms increase their investment by 10 million. National income increases by how much? 500 to 550. That is interesting. Firms increase their investment only by 10. But national income increases by 50, 500 to 550. Multiply. It multiply. Investment, change in investment is 10. Change in national income is 50. So ratio between change in income and change in investment is called multiplier of the economy. Multiplier of the economy. Right? I'll go to the board. What has happened when the investment increases from 50 to 60, income increase from 500 to I2, Y2, I1, Y1, 550. Change in investment is 60 minus 50, 10. Change in income is 50. So multiplier is called 50 change in income GDP divided by change in investment. That is M equals 50 divided by 10. M equals 5. This is called multiplier of the economy. Multiplier. Firms increase their investment only by 10 million. National income increases by 50 million. 50 million, right? 50 million. Why is that? Multiplier effect. Multiplier effect. Investment will generate in the economy. Investment will have a multiplying effect. Multiplier effect. Very important macroeconomic phenomena. Multiplier of the economy. Now, this economy is a very simple economy. Closed economy without government. Multiplier is 5. Again, when you extend this model, closed economy with government, another multiplier is there. Open economy, multiplier. Right? What does that mean? When this autonomous expenditure increases by certain value, 1 billion or 10 million, GDP increases by more than that. Ratio between increase in GDP, 50, and increase in investment, 10, is called a multiplier. This is an investment multiplier. Can have consumption multiplier, multiplier. Why is that? Investment projects, investment in the economy has a very important shock, multiplier effect in the economy, right? We go to this model. Right. Closed economy without government, what is the value of the multiplier? M equal delta Y over delta I. 50 over 10. 550 minus 500. 50. 60 minus 50, 10. That is 5. What do you mean by the multiplier? What do you mean by the now? This to explain the multiplier is, mathematical explanation is delta Y over delta I. What do you mean? How to explain that? It is how do you explain that investment? When companies invest initially, let's take the macroeconomic example. Now, Port City, Colombo Port City, huge investment project, billion worth of investment. Then the highways. Now, Central Highway is being compiled, being constructed. The Colombo Kandy, the highway is being constructed. Then you have another highway, the extension of this Mattala to the other areas, joining this the A9. There's another project, investment projects, building construction. Now the Kalani Palama, huge investment project is there. A Kalani Bridge, second lane, third lane, for the overhead bridge, the flyer is there. That is the investment project. When these companies invest, when the economy invests, the government invests money in these projects, final output, contribution to GDP will be much higher than that one. That is the multiplier effect. Multiplier effect. Why is that? When government invests this money, first round, what will happen? First round, what will happen? The government invest, government what? Exactly, the investor invest money, then what will happen? It will generate more and more economic activities in the economy. Efficiency improvement in the economy. Transportation will be easier. So, related economic activities, more the value of the related economic activities is much more than the initial investment. It's a multiplying effect, right? So then that's the importance of this multiplier, this model. Invest 1 billion worth of investment, national income will increase by 5 billion. Increase in national income means increase in employment to the people, increase in consumption to the people, people's consumption. That's good actually. But the funny thing is, same thing it will work opposite side also. Multiplier works opposite side also. When investment goes down by 1 billion, GDP will drop by 5 billion. That is the dangerous part. Investment in the economy goes down by 1 billion, national income will go down by 5 billion. Economy will shrink by more than the shock, right? So that's the multiplier is a very important concept. You can, in this national income model, you can explain the importance of changing autonomous consumption, changing consumption or changing investment, because they will generate some multiplying effect on the economy. That will economy will get benefited. So highway, that's a highway. How many activities? Transportation will increase, consumption will increase, transportation will, efficiency will improve, right? The cost of transportation will be reduced, right? So all these will be generated new activities. So sometimes the restaurants, new restaurants coming. For example, sometimes people travel from Colombo for their holidays, Colombo to Galle. Galle, there's lots of in the port. You have lots of the restaurants. People go and consume there. Just have a group of friends. They can just travel to. I know some of our friends go to Galle and come back. Activities, economic activities, travel activity, transportation, tourism increases, value addition increases. That's why this initial shock, initial investment project is important. Okay, let's go to the next one. Now the savings. I calculated that, no? Consumption. Well, initially, we have initial model income was the investment was 50, no? Investment 50, then national income was the 500. At that 500 level, I calculated consumption for 50 plus 0.8, 500. Initial model, first model, 450. Then what will happen? The savings equal income minus consumption. Remember first equation, y equals C plus S. Households are getting income. Why? Consume, save. We do that. Basically, what do? We consume, we save. Then if the consumption is 450, income 500. 500 minus total national income is 500. Then total consumption, national consumption of 450. Therefore, total savings level is 50. Well, I always try to explain these things using a household. If household income is 500, household consumption is the 450, household the savings is 50. Same thing can be generalized to the national income. If the national income GDP is 500, total national consumption level is 450, total savings level is 50. You know, multiplier also. Second model, closed economy with government. Now third player is coming. Earlier we had only two players, very simple model. Household sector, business sector, households and the firms. Now third player, who is the third player? Government is coming. Slightly complicated, sophisticated economy. Still, no international trade, import, export, MOX, no name there. Closed economy. Very old economy, primitive level, 1960s, 1950s, Sri Lankan economy like that. That time also we had a very small amount of import and export. You can't say it is the closed economy. It's a relatively open economy. During very long time ago, primitive economies. No government, the only households and the firms, right? Barter economy, something like that. Then the government, these organizations came. Now we have three players. When government introduced, what are the changes? This model, basic model. Government demand goods and services, G, from the firms. They need buildings for the schools, buildings for the hospitals, infrastructure development, road development. Then for that one, they need the goods and services, engineer services, doctor services, then some other physical the goods, chairs, tables, hospital beds. These are things. G represents the government demand for goods and services. But government as a unit, as a sector, as a player is a very lazy entity. Why do I say so? Government in any country, government depends on other people's money. Taxes, direct taxes, indirect taxes. Without taxes, they can't survive. Tax. Think about the developed country. Everything is taxed. Yeah, we have so many very poor people are not taxed. The employment categories are not taxed. But they are, irrespective of their employment category, employment level, income level, everybody is taxed. Even this taxi driver is also taxed. His earnings is taxed, right? He is getting the living, he will be living in a condominium flat, but he has to pay taxes. Out of his income, he has to pay taxes, right? Singapore, any developed country, all the taxi drivers, because I am using taxi drivers, because tuk-tuk or the three-wheel drivers are not taxi, and they don't pay taxes. But developed countries, everybody is taxed. Government live on those taxes. But government give services to these people, free services, free health, free education, free, most of them are free. But tax, you have to pay taxes. These are the two changes. From the one hand, government demand goods and services. From the other hand, household has to pay tax to the government. Now the formula slightly different. Now this time GDP equals Y equals C plus I plus G. C plus I plus G. When that generate income to the household, what do they do earlier? Y equals C plus S only. Earlier model. Household either consume or save. Now this time, households consume, pay taxes, balance saved from this side, right? Y equals GDP equals C plus I plus G. C plus I plus G. I plus G. Let's assume very rare case, funny case, extreme case. Government, no taxes. Government does not tax households. Very funny. Then one can ask the question, how do they get money? Sometimes maybe God is giving this money. Government cannot survive without taxing. But this extreme case, we assume without taxes. Calculation, how do they calculate? C equals C1 plus CY. Same consumption function. Well, in the model, I have indicated T. T0. We assume T0 because the next model, I am going to relax that. Then, no taxes. 50 plus 0.81. Investment expenditure, in value of investment is 50. Now, government expenditure is coming. Government demand 10 million worth of goods and services from the business sector. G, their contribution to the aggregate demand is 10. Now, the final, our idea is to calculate Y, GDP. 50 plus 0.8 Y consumption function, I 50, G 10. 50, 50, 100, 100 plus 10 is 110 plus 0.8 Y. If you take the 0.8 Y to the left hand side of the equation, Y minus 0.8 Y is 0.2 Y equal 110. Then Y equal 550. The three sector model, households, government, firms. Government also now economic player. They demand goods and services worth of 10 billion. Then as a result, GDP has increased by 50. Very first model, without the government, Y was 500. Only without taxes, without government model, remember very first model, Y was 500. Now when government comes, government another player. Government also generate economic activities in the economy. So value of the goods and services produced in the economy in that particular year is 550. Government is a new player. Understand? Okay. Now this without taxes case is very easy. Very easy. Handling is very easy, you know. But in the examination of the real world situation, we have to pay taxes. Without tax case model is funny. Government cannot live without taxes. Next model, we come to with taxes. Taxes, earlier I said there are two types of taxes. Lump sum tax, proportional tax. And the lump sum tax, whether income is 1,000, taxable income 1,000 or 10,000 or 1 million, households pay same amount of tax. Corporate taxes same. Lump sum pay. It does not link to the income of the household, income of the company. Other tax system, tax scheme is proportional taxes. Some percentage is tax. 10% of your income is tax. This T is called proportional tax rate. 10% of your income is tax. You calculate the taxable income. Sometimes if your income is, let's say, 1 million rupees, then government, in most of the cases, they give tax relief. your income is 1 million, 1 million, 10 lakhs, right? Then your tax exemption is there for about, let's say, the 100,000. 1 lakh is exempted. You are not paying taxes. Therefore, 100, the 10 million minus the 100,000. Sorry, 1 million. So I'm sorry. Income, we assume the 10 lakhs, 1 million, 10 lakhs. Annual income is 1 million, 10 lakhs. First 1 million is exempted. Therefore, you deduct 1 million. Therefore, your taxable income is 9 lakhs, 900,000. 100,000 is exempted. Taxable income 900,000. From that 900,000, 10% is tax. 10% is tax. 900,000, 10% is tax. 900,000, the 10% is tax. Understand? 90,000. 900,000, 90,000, no? 90,000, 900,000 divided by 900,000. 10% is tax into 0.1. 90,000. Tax is 90,000. Understand the calculation? 90,000. You are getting your taxable income is 900,000. Of that, 10,000, 10% is tax. 90,000. You give 90,000 to the government. Of your total income, you pay 90,000 as a tax to the government. What will happen to your income? Decreases. Income decreases. If the taxable income is the 10 lakhs, you pay the 100,000 to the government. Your taxable income is, let's say, the 10 lakhs. You pay 10% of that to the tax government. That is 1 lakh is paid as a tax. Then you have only 900,000, 9 lakhs. Understand? Early example, I was thinking tax exemption is 100,000. Then the calculation was different. Let's assume your taxable income is 1 million, 10 lakhs. Of that, 10% is tax. You pay 100,000 to the government. You have only 900,000. What I am saying is, when there is a tax, your disposable income decreases. What is disposable income? Decreases. The real actual income that you can use to buy goods and services. After tax income, disposable income. YD is defined as Y minus T. Y minus T. An example, let's say income 100,000, say 10 lakhs. You pay the 100,000 to the government. 10 lakhs minus 100,000 is 900,000. 900,000 is the disposable income. Actual income minus the tax is the disposable income. The tax is not the income of the government. You are left with YD only. Then tax rate T is equal to what? TY. 10% into income. 10% into 100,000. 10% into 100,000. I equal 50. As earlier, we assume I equal 50. As earlier, we assume G is 10. G is 10. Now you substitute. Substitute Y equals 50 plus. Now the consumption fund. What are the other changes? Consumption is, now this time, C1 plus CYD. So the consumption depends on your disposable income. Not the actual income. You don't have 100,000, 1 million. You have only 900,000, 9 lakhs, not the 10 lakhs. Disposable income. So therefore, the consumption depends on disposable income. If there's a tax, C equals CYD, YD equal Y minus T, T equals TY, I is 50, G is 10. How do you calculate the YD? YD we calculate Y minus T. What is T? 0.1Y. T is TY, 0.1Y. Then you substitute this thing into the function of equation y equals C plus I plus G. 50 plus 0.8, YD is Y minus 0.8Y. That is TY, taxes. Investment 50, government expenditure 10. Then you simplify 110, 50, 50, 100 plus 10, 110. 0.8y, expand this bracket, minus 0.8 into 0.1 is 0.08y. Bring all y terms to the left hand side. Answer will be y minus 0.8y plus 0.08y. Answer is 0.28y equals 110. Y equals 110 divided by 0.28. 110 divided by 0.28. $392.22. 392.22, yes, 0.28. 0.8. That is the income. Closed economy with government with proportional taxes, 10%. What will be the income? Total income will be 392. Earlier what happened? Closed economy with government without taxes. Income was 550, GDP 550. But that of course highly unrealistic model. Without taxes, government cannot survive. No? This time what will have? Proportional taxes, income definitely come down, 392. Why is that? People's purchasing power decreases. Purchasing power decreases. So the disposable income decreases. Purchasing power, disposable income decreases by the amount of taxes they pay tax to the government. As a result, total GDP increases. Now there is an important point. Government is getting tax revenue, TY, 0.1 into Y, 392, 0.1 into TY. Government tax revenue, government is getting taxes. 0.392 into 0.10, 0.1, 10% into 392. That is government tax revenue. What is tax revenue? T, you can calculate taxes. 0.1 into 392. That means 392, let's say 392, forget about the decimals, into 0.1. 3920. Government tax revenue 3920. GDP decreases 392. But if the government used their tax revenue to increase the investment, productive capacity, increase investment, government investment, public investment in the economy, that will generate more income next year or following year. Can say the income. Otherwise, you might ask, well, what happened when government is there? GDP has gone down to 392 government taxes. Yes, that's true. But government, out of their tax revenue, if they can increase the economy's productive capacity, investment level that generate more income, then economy is benefited. Understand? Or this justify the government taxes. If government collect taxes from various sources, if you don't do that, if the government put that into a bin, you don't do anything about that. You keep those money in the bank, government. In that case, national income decreases. But if government use part of their tax revenue to increase investment, definitely next year or the following year GDP will increases. Multiplier there. GDP increase. So you might think government tax is, if you this example directly think about this example, government taxation is bad. That reduces the people's the disposable income. By then again GDP decreases. Yes, agree. But government getting tax revenue of 39 million. Of that 39 million or 39 billion, they can increase part of that. The government can invest. If they increase 20 million, that will generate more income next year. Next year GDP increases. That is the argument. You can't say taxes bad, taxes good. Taxes bad argument is taxes reduces people's disposable income. Taxes reduces country's GDP. But this year, next year, following year, GDP definitely will increase if the government increase the investment, invest part of their tax income on the government other investment purposes. Right. Open economy model. Now we are getting complicated here. Open economy. What are the new sectors? How many sectors? Households, government, firms. Now here you don't have that sector, it is hidden. What is that? Foreign sector. Foreign sector is there. Rest of the world sector is there. Rest of the world, goods going to the rest of the world, exports. Goods coming from the rest of the world, imports. So this model is 4-sector model. 4 sectors: household sector, government sector, business sector, foreign sector. Think about our economy today. We have households. We have government. We have businesses, privately owned, government owned, they are called business sector. We have the rest of the world, import export. That is the open economy, the open economy model. Last week we discussed, we combined that with the market also. Markets of goods market, financial market, like that, the labor market, we have the markets also. Here we have only sectors. Sectoral breakdown of the economy. Households, government, firms. Now let's assume, because when there's a rest of the world comes, we don't say GDP, we have GNP, gross national product. Remember difference between national and domestic? GDP and GNP, money coming in, money going out, money coming in, money going out. We have adjustment for the net fact income from abroad. That's why in the open economy, we can't say GDP, we say GNP. GNP equals what? Consumption goods for the households. Then government demand goods and services, G for the government. Demand coming from the government. Goods from the government. Then investment goods for the other firms, inter-industry firms. Exports, firms produce exports. Tea, rubber, coconut, paddy, mine export crops. These are the exported items. Jewelry, gems, exported. Packeted tea, exported. Exported, and then cinnamon, exports. Right. Cinnamon is a very important, the exported item of the country. Our cinnamon is the world best. There is another, the subgraded, the inferior cinnamon coming from to the world market, but the people world demand is there to the Sri Lankan cinnamon. The huge demand is there. Good quality cinnamon is there. We produce good quality cinnamon, right? Okay, that is exported item. So the GNP equals C plus, I plus, G plus, X. But we have to, these exports, we have the exported goods are there, value of goods and rupee value is there. But we spend something on the imports also, no? So you deduct that, you net out, X minus M, net exports. So country's GDP, determination of GDP is what? C, I, G, X minus M, net exports. Because of the imports, GDP going down, going out of the country. Demand, it's a demand for foreign goods. We don't produce domestically. Therefore, we deduct that net exports. So equation is C plus, I plus, G plus, X minus M. Understand? C plus, I plus, G plus, X minus M. That is the final national income identity of foreign open economy. So you should be able to explain each and every component of the in the national income, this identity. What is consumption? Consumption depends on disposable income. Why is that? Because there is a government. Government imposes taxes. What will happen? You are getting 1 million, but you pay 100,000 to the government. Therefore, your disposable income is the 1 million minus 100,000, that is 900,000. 9 lakhs. 10 lakhs minus 1 lakh is 9 lakhs. YD. Then what is taxes? Tax system is not lump sum. Here we assume it is proportional taxes. 10% of your income, nominal income is tax. You pay taxes on the 100,000. Taxable income, let's say 100,000, 1 million. T equals TY. I50 as earlier, G10 as earlier. We assume tax rate is 10%. Marginal tax rate is 10%. Exports 50. Imports again. Now I will explain these last two items. Export 50. Exports, demand for our export depends on what? Demand for tea, demand for garments, demand for rubber, demand for the housemaids, demand for quantity surveys, demand for our goods and services depends on what? Who determine their demand? Rest of the world determine. US, Russia, then the Singapore, Japan. These countries demand our exports. Understand? Otherwise, if they don't demand at all, we don't have any exports. If Japan does not demand jewelry, gem and jewelries, we can't import. If US does not demand, because the US is the major giant for our garments. They don't demand our garments. Our exports, government exports are very small. If European countries don't demand our garments, zero. If European government does not, countries do not demand our fisheries products, zero. Understand? That is the danger of this one. Our trade embargo are there in when Iran is subject to the trade embargo. Iran is not permitted to sell oil to other countries. That is the US, some restrictions are there. Embargo. Their main source of revenue, Middle East countries, main source of revenue is selling oil, selling crude oil. So then, because of these geopolitical reasons, countries, governments impose restrictions, trade embargoes. Iran, the US has imposed some trade restrictions. Then what will happen? They are not permitted to sell oil to other countries. Right? That's a big problem. Sometimes they use different ships. They smuggle secretly they sell oil to other countries. Recently that happened. One of the countries with the trade embargo, they try to sell this oil using Venezuelan ships. another ships. Sometimes in the middle of the sea, they change the color of the ship. Sometimes change different the flags. But with the current technology, everything is transparent. 100% transparency is there. You can't pin down what are they doing. So therefore, exports depends on foreigners' income of the other countries, income of US, income of Japan, income of the European countries, income of Malaysia. If these incomes are going down, shrinking, like COVID, like the world, this COVID pandemic situation, all the economies shrank. Then demand for exports decreases. Exports demand is demand for export determined by the performance, economic performance, or the economic growth rate, GDP levels of other countries. Here we will assume export is 50. We assume world demand for our export is constant, 50. Investment 50, government expenditure 50, tax rate 10%. Exports, world demand 50. Imports. We demand imports. Imported shoes, imported shirts, imported computers, imported smartphones. Right? We demand. Sri Lankan demand. Demand depends on what? Demand for import depends on our GDP. Why? If our economy is performing well, demand for imports also increases. Think about households. When our income increases, what will happen? Household income increases. Partly you demand domestically produced goods. Again, you demand foreign goods. If you have a simple phone, let's say 3,000, 4,000, 2,500, very simple, basic phones. Then your income increases, you will go for smartphones. 30,000, 25,000, 35,000, 100,000 smartphones. They are important. When income increases, imports increases. Demand for imports increases. That's why we have said M equals 0.05y. This 0.05y is our GDP, our income. Imports depends on the import function. Import depends on our income. Sri Lanka's GDP. 0.05 is called marginal propensity to imports. That small c is called what? Marginal propensity to consume. MPC. This 0.05 is called marginal propensity to imports. Now you can understand what does that mean. 0.05 is when our GDP, when income increases by 1 rupee, your imports increases by 5 cents. Income increases by 1 rupee. Demand for imports increased by 5 cents, 0.05, 5 cents. That is called the marginal propensity to imports. MPM. MPC, 0.8. Remember earlier example. When income increases by 1 rupee, consumption will increase by 80 cents. 80 cents. Correct? Now, let's discuss MPC 0.8, MPM 0.05. Then what will happen? When your income increases by 1 rupee, people increase their consumption by 80 cents. 1 rupee increase in income, consumption will go up by 80 cents. Then imports increase by 5 cents. Then 85. Balance 15 cents is saved. MPS is 0.15. MPC 0.8. MPM 0.05. MPS 0.15. That is then equation. If income increases by 1 rupee, people increase their consumption by 80 cents. Increase the demand for imports by 5 cents. Then balance 15 cents is saved. MPS is saved. I'll write down the formula. What is marginal propensity to consume? This is marginal propensity to imports. What will happen? When income increases by 1 rupee, people increase consumption by 80 cents, increase imports by 5 cents, then total is 85 cents. MPS is what? Balance 15 cents is saved. Balance is what? Is change in income. Income increased by 1 rupee. This is how we distribute. Consumption increased by 80 cents. Imports increased by 5 cents. Savings increased by 15 cents. MPC, MPM, MPS. MPC plus understand? That is the identity. Marginal propensity is sum of 3 marginal propensities equals 1. Right. Now we understand this open economy model, meaning of each terms. Consumption depends on consumption depends on disposable income. What is disposable income? Y minus T. How do you explain T? T equals TY. Investment equal 50. Government expenditure 110. Tax rate is 10%. Export depends on income of the rest of the world, income of other GDP, other countries' GDP. But import depends on demand for import depends on our GDP. 0.05Y. Then we can substitute this. Substitute. C, 50 plus 0.8 YD. What is YD? Y minus 0.1Y. Y 0.1, 10% tax. 0.1Y. T equals TY, no? Y minus T. 0.1Y. Understand that calculation? Y minus T. Disposable income is Y minus T. T is what? TY. How do you calculate TY? 0.1Y. 50 plus 0.8 marginal propensity to consume into YD is Y minus 0.1Y. Please go through these calculations again. Then understand how to calculate. 50 investment, 10 government expenditure, then exports 50 minus M. Minus M is 0.05Y. Understand now calculation? C plus I plus G plus X minus M. You substitute all these things. Finally, Y equal 50 plus 50 plus 100, 100 plus 50, 150 plus 10 is 160 numbers. Then you get y terms, 0.8y. You multiply 0.8 by 0.1y, 0.08y minus, then last term 0.05y. So then you simplify, you take all y terms to the left hand side. Simple mathematics. I want you to work out this again. 0.1y, then 0.33y equals 160. You bring 0.8y to the left hand side, 0.08y to the left hand side, 0.05y to the left hand side. Both are pluses. Minus 0.08 becomes plus, 0.05 becomes plus, 0.8y becomes minus, right? When you take them into left hand side. 0.33y, 160y equal 480. Y equal 460. 180. 4 sector models. Households, government, business, firms, rest of the world. 4 sector models. Now we calculated GDP 480. Similarly, we can calculate the distribution value of consumption goods, value of taxes. Taxes you can calculate 480 into 10, 0.1. 480 to 0.10, 0.1 is 48. 48 is the tax rate. I can calculate this, remember. So the 480 is the income is 480. Tax rate is 0.1. So government tax revenue is what? TY. Tax revenue is 48. 48. Disposable income? Income 480 minus 48. Your nominal income 480. You pay taxes 48. Disposable income 438. 438. Consumption? Consumption equals 50 plus 0.8 YD. YD is 438. 432. 432 is 0.8 into 432. 345, 60. Sorry. 0.8 into equals plus 50. 395, 60. 395, 60. 395, 60. Yes. Right. Okay. Like that, you can calculate. You can calculate this numbers. You can calculate these numbers. Yes, yes, you can calculate decimal something like that. You can calculate this circular flow Everything can be calculated. Once you calculate the Y, you can calculate tax revenue. When you know the tax revenue, you can calculate disposable income. When you know the disposable income, you can calculate consumption. Then consumption is known, investment is known, government expenditure known. Then you can balance this, go to this model. You can calculate this. Everything can be calculated. This is 480. 480 disposable income, consumption, investment, exports, government expenditure. Everything can be calculated. Then balance, you can balance this the circle. All the numbers can be calculated. Tax revenue is 48. Tax 48. Then government expenditure 50. Imports 0.05y. You can calculate. Savings, when you know consumption 432, consumption 395, then taxes we know calculated 48, imports you can calculate, savings. Like that, this national income identity model can be balanced. Right? Okay. Of course, now this, hello, you want to ask something? Hello, right? Now this of course the savings investment balance, the identity we discussed last week also. The closed economy without government equality, Y equals C plus S, GDP equals C plus I, then savings equals investment. What is the economic implication? Closed economy without government, private investment, business investment is financed purely by the household savings. I equals S. Next model. Y equals C plus S plus T. GDP equals C plus I plus G. When they are equals, I equals S plus T minus G. Now we have two players, household sector and the government, business sector. Business sector investment I is financed using savings, household savings plus government savings, T minus G. Two players. Household savings plus T minus G. If government does not save, in Sri Lankan case, government savings negative, minus, not plus. Then what will happen? Big problem. Household saves, government dissave. Then investment will be less than the private savings. Let's say private savings is 100, government savings minus 10. Investment you will see 100 minus 10, 90. Investment 90. Household savings 100. Let's say government savings minus 10. Dissave. Then what is investment? 100 minus 10, 90. What has happened? Total business sector investment is less than the private savings. Why? Government savings negative. That is the issue. In this part of the world, in most of the third world countries, most of the governments dissave, T minus G negative. Actually, you can't say government dissavings is bad always. Right? Because government is these savings, they pay salaries and wages, they pay pensions to the people, they pay the loan installment. That's why the current expenditure is much higher than T minus G is negative. You can't say it is bad. You are the They also generate economic activity. They finance lots of economy. They give money to the pensioners. Pension payment. Government teachers, engineers, doctors, pensioners, they are getting salaries. Then again, they pay interest on the government debt. Right? Therefore, you can't say it is always bad. But the thing is, total investment is private investment is financed. You don't have money. Then we need money from the outside world. Foreign direct investment, FDIs. We need help from other countries. We need help from China. We need help from India to develop our ports, right? The eastern, jetty or the other the western jetty, right? So then that is what we call that, yes, port, development of port. So India will develop our harbors, Hambantota Harbor. I guess these are some foreign direct investments we need, because we don't generate enough savings to finance the investment. House road projects, we borrow loans, we get loan from other countries. Right? Now getting loans, definitely you can say it increases, balloon the debt stock. Agreed. Debt stock. But at the same time, if they generate GDP the coming years, next year, following year, 5 years time, 10 years time, they increase our GDP, current level per capita income 4,000 to 10,000. If you can increase our GDP, then servicing these debt is not the problem. Your GDP, but it takes time. It takes time. Understand? That's the issue. Then the final model, we want to check how does private investment is financed, is financed. What are the sources? Sources: S, private household savings; T minus G, government savings; M minus X, foreign savings. Foreign savings. Right? We don't consider this financial flows, goods flow. M minus X, sorry, M minus X. Then this is the full model. We have to finance the private sector investment. We have 3 players: private households, government, the household sector, government savings, savings coming from the rest of the world. This is the identity. If government is saved, we don't have enough, private sector doesn't have enough funds. If foreign savings negative, private sector not enough funds. If households is saved, we don't have enough funds. So they are for investments. Then we seek help from foreign countries to increase our investment. But investment is important. Investment generate economic activities, increase future productivities, increase GDP. GDP generate employment. Think about this Kalania Bridge. How many people are working? I don't know, 500, 100. How many subcontractors are there living on this one? So, lots of economic activity. Subcontractors are there, right? Labor contracts. Then other suppliers of this are the cement, the maybe sometimes bricks, sometimes the rubber, sand suppliers, huge. So it's distributed. Okay, now this is the model I want you to go through, because these mathematical equations are very important. You can understand calculations very simple. They are simple equation. But the behind those equations, lots of economic concepts. I want you to first understand the calculations using the equation. You all are, I am sure you all are familiar with the simple mathematics solution to the simple equation. Then you go back to this. So then understand deriving these things, understand the concept, then go to the model and explain that. Now that is the first model we discussed. The first model about the economy. Next week, of course, I will discuss some past paper questions, or sometimes maybe some I will give some equations and ask you to calculate, work out in the exam, right? Then we can go to the ISLM model. ISLM model, then the aggregate demand, aggregate supply model, then understand the aggregate ADAS model. Okay, we'll stop now. Thank you very much. Please understand. I'm sorry if some of you are not be familiar with this mathematical calculation, but they're not difficult. Simple equation. Please understand these equations and calculations, right? So all the models are there. Okay, thank you very much. We'll stop now. See you all next Sunday, coming Saturday, right? Thank you.
Thank you, sir.
Thank you. Thank you. Thank you.